Imagine watching the stock market struggle while a handful of funds quietly deliver eye-popping gains of more than 90% in less than a year. And now, picture gold, already smashing through record highs, being on the edge of what could be its most explosive move yet. Sounds unbelievable, right? But September 2025 is shaping up to be exactly that moment. We're less than 2 weeks away from a Federal Reserve decision that could change the entire landscape for precious metals, and investors who understand the setup now could be positioning themselves for what might become one of the biggest opportunities of the decade. Gold isn't just doing well, it's rewriting expectations. In January, analysts thought $3,200 an ounce would be an ambitious year-end target. By July, gold had already pushed through that mark, and now here we are with prices crossing $3,500 per ounce, a level nobody thought realistic just 6 months ago. That's a 35% surge year-to-date. But here's the twist. While the headlines focus on gold itself, the real fireworks are happening in the companies that mine it. This is where most people get caught off guard. A $100 rise in gold doesn't mean a miner rises by $100. Thanks to what's called operational leverage, the same move can translate into gains many times larger for mining companies. And we're seeing that play out right now. 3 gold-focused ETFs aren't just keeping pace, they're outpacing gold dramatically, climbing over 90% in under 9 months. Why now? A perfect storm of conditions is brewing. The Federal Reserve meets on September 16th and 17th with a 90% probability of at least a quarter-point rate cut. Rate cuts typically weaken the dollar and make non-yielding assets like gold much more attractive. Add in a dollar already down 2.2% in just the last month, rising demand from international buyers, and persistent global tensions, and the recipe looks like the beginning of a gold supercycle that could last years. Let's break down the funds that are riding this wave. First, the VanEck Gold Miners ETF, or GDXJ. Year-to-date return, 93.99%. That's almost a doubling in value in under 9 months. GDXJ focuses on smaller mining companies, junior miners, that respond dramatically to gold price moves because their operations are highly sensitive to commodity shifts. This fund holds 88 securities, including companies like Alamos Gold, Pan American Silver, and B2 Gold. It manages around $6.87 billion, charges a 0.51% expense ratio, and even pays a 1.35% dividend yield. Junior miners are often in earlier stages of production, and with gold hitting record levels, they're ramping up projects that were once on hold. Every extra dollar in gold prices translates into multiple dollars in their valuations. That's why this ETF is at the top of the leaderboard. Next is the VanEck Gold Miners ETF, or GDX. With a 91.14% year-to-date gain, it nearly matches junior miners while bringing more stability. Instead of small players, this ETF invests in large, established mining companies with global operations. Think Newmont, Agnico Eagle Mines, and Barrick. GDX holds 66 securities and manages $19.52 billion, making it one of the largest in its category. Its top 10 holdings account for nearly 66% of assets, giving concentrated exposure to the industry's most reliable players. These companies operate across Canada, the United States, Australia, Brazil, and South Africa, reducing country-specific risks. The fund yields around 0.90%, not a massive dividend, but steady income on top of capital gains. And importantly, GDX recently adjusted its benchmark strategy to better capture opportunities in today's gold environment. Then there's SPDR Gold Shares, or GLD, the go-to fund for pure gold exposure. Its 26.96% gain this year may look modest compared to the mining ETFs, but it represents the raw performance of gold itself. With over $17 billion under management, GLD is the largest gold ETF in the world. Each share represents actual physical bullion, 99.99% pure gold stored securely in vaults. No mining risks, no labor strikes, no permitting delays, just direct exposure to gold. Its expense ratio is only 0.40%. The trade-off? GLD doesn't pay dividends, and in the United States it's taxed as a collectible, which means a higher long-term capital gains rate of up to 28%. But for investors who want simplicity and direct exposure, it remains unmatched. Now, why is September so important? Because, well, multiple factors are converging. There's a Fed decision that could push rates lower. Gold is breaking through technical resistance levels on strong volume. Plus, there's seasonal demand, especially from Asia during festivals. And let's not forget the ongoing central bank gold purchases, which are providing steady demand. Price forecasts are climbing fast. At the start of the year, $2,756 was the target. By midsummer, analysts moved that to $3,200. Now, projections run as high as $3,600 to $3,900 by the end of this year, and potentially $4,000 by mid-2026. If that happens, mining ETFs could gain another 50 to 100% from current levels. So, how do you play it? Allocation really depends on your risk profile. If you lean conservative, you might go with 70% GLD and 30% GDX. That way you get the stability of gold itself with some leveraged upside. Now, if you're more balanced, you could try 40% GLD, 40% GDX, and 20% GDXJ. This spreads the risk while still giving you exposure to both large and small miners. And for those who want to be aggressive, 30% GLD, 35% GDX, and 35% GDXJ offers maximum upside potential, but yeah, also maximum volatility. Whatever the mix, consider dollar cost averaging instead of jumping in all at once. Gold and miners can be volatile, and spreading out purchases helps you avoid buying at those short-term peaks. But let's be clear, this isn't risk-free. Mining ETFs, especially GDXJ, can swing 5 to 10% in a single day. Companies face all sorts of operational risks like equipment failures, environmental issues, or even regulatory changes. Currency fluctuations also matter since a lot of miners operate internationally. And, in broad market sell-offs, gold often drops at first before it recovers that safe haven appeal. Even geographic risks, like political instability or resource nationalism, can really weigh heavily on miners. The bottom line is this. The setup right now is honestly one of the strongest gold environments in over a decade. Between interest rate cuts, a weakening dollar, technical momentum, seasonal demand, and central bank buying, the stage is set for a potential multi-year cycle. The question isn't if gold will keep rising, it's how you choose to take part in it. If this breakdown gave you a clearer picture of the opportunity and how to think about positioning, make sure to hit that subscribe button to MoneyQuest Broker. We'll keep diving into strategies that actually matter and help you make sense of what's happening in the markets. And remember, this is for educational purposes only. Past performance never guarantees future results. Always do your own research and consult a qualified financial advisor before investing.